Welcome to our comprehensive exploration of the psychology of investing. In this guide, we'll dive deep into the intricate workings of the human mind and how it influences investment decisions. Understanding the psychological underpinnings of investing is crucial for investors to navigate the volatile and often unpredictable world of financial markets. From cognitive biases to emotional responses, we'll uncover the inner workings of the mind and provide insights into how investors can make more rational and informed decisions. Number 1. Cognitive biases in investing. Unveiling the hidden influences. Cognitive biases are deeply ingrained mental shortcuts that can significantly impact investment decisions. One common bias is confirmation bias, where investors seek out information that confirms their existing beliefs while ignoring contradictory evidence. This bias can lead investors to overlook warning signs or dismiss alternative viewpoints, ultimately clouding their judgment. Similarly, availability bias occurs when investors overweight recent or easily accessible information in their decision-making process. This can cause them to overlook long-term trends or fundamental analysis in favor of short-term news or market trends. Understanding these biases is crucial because they can lead investors to make irrational decisions based on faulty reasoning, ultimately undermining their investment performance. Number 2. The role of emotions in investment decision-making. Riding the roller coaster. Emotions play a significant role in investment decision-making, often leading to both positive and negative outcomes. Fear and greed, for example, can cause investors to panic sell during market downturns or chase speculative investments during bull markets. Conversely, disciplined investors who can manage their emotions effectively are better positioned to capitalize on opportunities and navigate market volatility with composure. Developing emotional intelligence and maintaining a long-term perspective are essential for successful investing. Additionally, understanding the emotional cycle of investing, which includes stages of euphoria, anxiety, denial, and capitulation, can help investors stay grounded and make rational decisions amid market fluctuations. Number 3. Risk perception and risk tolerance. Striking the right balance. Risk perception varies widely among investors, influenced by factors such as personality, experience, and financial goals. Understanding one's risk tolerance, the amount of uncertainty an investor can tolerate without experiencing undue stress, is essential for constructing a well-balanced investment portfolio. Some investors may have a high risk tolerance and feel comfortable with aggressive growth strategies, while others may prefer more conservative approaches focused on capital preservation. Achieving the right balance between risk and reward requires careful consideration of individual circumstances and objectives. Moreover, risk perception is dynamic and can change over time, especially in response to market conditions or life events. Regularly reassessing risk tolerance and adjusting investment strategies accordingly is critical for long-term success. Number 4. Herd mentality. Navigating the crowd's influence. Herd mentality, or the tendency to follow the crowd, can exert a powerful influence on investment decisions. When investors see others buying or selling a particular asset, they may feel pressure to do the same, regardless of whether it aligns with their own analysis or investment strategy. While herd behavior can sometimes lead to momentum-driven price movements, it can also contribute to market bubbles and subsequent crashes. Recognizing the potential pitfalls of herd mentality and maintaining independent thought are crucial for avoiding herd-induced investment mistakes. Moreover, understanding the underlying reasons for herd behavior, such as fear of missing out, FOMO, or seeking safety in numbers, can help investors resist the urge to blindly follow the crowd and make more informed decisions based on their own analysis and research. Number 5. Overcoming overconfidence. Recognizing the limits of knowledge. Overconfidence bias is a common psychological trap that can lead investors to overestimate their abilities or knowledge. Investors who suffer from overconfidence may believe they have unique insights or predictive abilities that give them an edge in the market. However, research has shown that overconfidence often leads to excessive trading, poor risk management, and suboptimal investment outcomes. Recognizing the limits of one's knowledge and seeking diverse perspectives can help mitigate overconfidence bias and promote more prudent decision-making. Additionally, developing a healthy skepticism and continuously questioning one's assumptions can help investors avoid falling victim to overconfidence and remain open to new information and alternative viewpoints. Number 6. Anchoring bias. The power of initial reference points. Anchoring bias can significantly impact investment decisions, as individuals often anchor their judgments to the first piece of information they receive. For instance, if an investor hears a stock is trading at a certain price, they may subconsciously use that price as a reference point for determining its value, even if other factors suggest otherwise. Overcoming anchoring bias requires investors to actively challenge their initial impressions and consider a broader range of information before making decisions. Strategies such as conducting thorough research, seeking diverse opinions, and periodically reassessing one's assumptions can help mitigate the influence of anchoring bias. Number 7. Loss aversion, the fear of losing out. Loss aversion can lead investors to make irrational decisions driven by their fear of experiencing losses. This bias often manifests in investors' reluctance to sell losing investments, even when it may be in their best interest to do so. Overcoming loss aversion requires a shift in mindset towards accepting losses as a natural part of investing and focusing on the long-term performance of the portfolio rather than short-term fluctuations. Implementing disciplined investment strategies, setting predefined exit points, and diversifying one's portfolio can help investors manage the emotional impact of loss aversion and make more rational decisions. Number 8. Recency bias, short-term memory in investment decisions. Recency bias can cause investors to overweight recent events or performance when making investment decisions, leading to suboptimal outcomes. For example, investors may become overly optimistic after a period of market gains or excessively pessimistic following a downturn, disregarding historical data and long-term trends. To counteract recency bias, investors should take a more balanced approach to evaluating information, considering both short-term developments and broader market dynamics. Maintaining a focus on fundamental analysis, adhering to investment principles, and avoiding knee-jerk reactions to short-term fluctuations can help mitigate the impact of recency bias on investment decisions. Number 9. Sunk cost fallacy, letting go of past investments. The sunk cost fallacy can trap investors into holding on to losing investments due to their emotional attachment to past decisions. This bias leads individuals to factor sunk costs, such as time, effort, or money already invested, into their decision-making process, even when it is irrational to do so. Overcoming the sunk cost fallacy requires investors to adopt a forward-looking approach and base decisions on the potential future outcomes rather than past investments. Setting predefined criteria for exiting investments, seeking objective advice from trusted sources, and regularly reassessing the investment thesis can help investors avoid falling prey to the sunk cost fallacy. Number 10. Mental accounting, segregating investments into mental buckets. Mental accounting involves categorizing financial decisions into separate mental accounts, which can lead to suboptimal investment outcomes. For instance, investors may allocate different levels of risk tolerance or investment goals to various mental accounts, leading to inconsistent decision-making across their portfolio. To overcome mental accounting bias, investors should adopt a unified approach to financial planning, considering their overall financial objectives and risk tolerance when making investment decisions. Implementing a diversified investment strategy, periodically rebalancing the portfolio, and seeking professional advice can help investors avoid the pitfalls of mental accounting and achieve their long-term financial goals. Number 11. Confirmation bias, seeking validation for existing beliefs. Confirmation bias occurs when investors seek out information that confirms their pre-existing beliefs or opinions while ignoring or dismissing evidence that contradicts them. This bias can lead investors to overlook potential risks or flaws in their investment thesis and make decisions based on selective information. Overcoming confirmation bias requires investors to actively seek out diverse perspectives, challenge their assumptions, and remain open to alternative viewpoints. Conducting thorough research, seeking feedback from trusted sources, and considering a range of perspectives can help mitigate the impact of confirmation bias on investment decisions. Number 12. Overconfidence bias, overestimating abilities and knowledge. Overconfidence bias involves investors overestimating their own abilities, knowledge, or predictive skills when making investment decisions. This bias can lead investors to take on excessive risk, trade too frequently, or ignore warning signs of the market. To counteract overconfidence bias, investors should adopt a humble approach to investing, recognize their limitations, and seek to continuously improve their skills through education and experience. Implementing risk management strategies, maintaining a diversified portfolio, and seeking feedback from objective sources can help investors avoid the pitfalls of overconfidence bias. Number 13. Herding behavior, following the crowd. Herding behavior occurs when investors mimic the actions of others without independently evaluating the merits of their decisions. This behavior can lead to asset bubbles, market inefficiencies, and increased volatility as investors react to perceived trends or social cues rather than fundamental factors. To mitigate the impact of herding behavior, investors should maintain independence in their decision-making process, conduct thorough research, and resist the temptation to blindly follow the crowd. Developing a contrarian mindset, focusing on long-term fundamentals, and staying disciplined during periods of market volatility can help investors avoid the pitfalls of herding behavior. Number 14. Endowment effect. Overvaluing owned assets. The endowment effect refers to the tendency for individuals to assign higher value to objects or assets they own compared to identical objects they do not own. In investing, this bias can lead investors to hold onto investments longer than they should or overvalue their existing holdings, even in the face of new information or changing market conditions. To overcome the endowment effect, investors should adopt a rational approach to assessing the value of their investments, considering objective criteria and market dynamics, rather than emotional attachment. Regularly reviewing and reassessing investment decisions, seeking input from trusted advisors, and maintaining a disciplined investment strategy can help investors avoid falling prey to the endowment effect. Number 15. Availability bias. Focusing on easily accessible information. Availability bias occurs when investors place undue emphasis on information that is readily available or easily recalled, while discounting less accessible or less memorable information. This bias can lead investors to overestimate the likelihood of certain outcomes based on recent or vivid events, rather than considering the full range of possibilities. To counteract availability bias, investors should seek out diverse sources of information, conduct thorough research, and consider a range of potential scenarios when making investment decisions. Developing a systematic approach to decision-making, avoiding snap judgments, and consulting with experts can help investors overcome the limitations of availability bias and make more informed investment choices. As we conclude our exploration into the psychology of investing, it's clear that understanding and recognizing these common thinking errors is essential for making sound investment decisions. By being aware of biases such as anchoring, loss aversion, and confirmation bias, investors can avoid costly mistakes and navigate the complexities of the financial markets with greater confidence. Remember, investing is not just about numbers and analysis. It's also about understanding human behavior and psychology. So the next time you find yourself faced with a tough investment decision, take a step back, evaluate your thought process, and strive to make decisions based on logic and reason rather than emotion. Stay informed, stay disciplined, and may your investments be prosperous. Don't forget to subscribe for more insightful content on investing and finance.